I had a lot of comments come in, a lot of questions, a lot of good discussion that came in on YouTube during the last 5 or 6 days. And last night, I missed it until this morning, but last night, one of the YouTubers asked a question. This is from Oleg, and he says, can you do a demo on covered calls? The stock is going down beyond the purchase price, so we can see how to use the software to find the solution to get out with a profit. Absolutely. We're going to look at 2 quick examples. We're going to use DAR as a covered call. It's one I'm familiar with. I'm actually in as a married put that had an income method number 6 that hit expiration today. We might talk about that later in the presentation. And I looked for another position that was in a steep decline, and I came up with a stock called Boom. I think it's Dynamic Materials. You can guess what they kind of do. But we're going to take a look at these 2 covered call positions and how we would use PowerOptions to help us manage those positions as well. So first, the DAR trade. On March 9th, the stock was trading at 78.52. These are closing prices. And then yes, of course, naturally, I grabbed it near the peak so that we could see the worst possible case scenario today. But on March 9th, we could have bought the stock at 78.52 and sold the March 80 call, slightly out of the money, for 210. Not necessarily the approach I would use, but this is just for an example. Well, we knocked our cost basis down to 76.42. We were hoping for a 4.7% return if the stock was above 80. But as you can see, the stock dropped down to 72.64, was as low as about 71.90 today. And our liquidation on today's expiration is 5.2%, a loss of 5.2% with sort of slightly out of the money covered call positions. Now, as we're tracking the position in the PowerOptions tools, we would go to the position analysis view to evaluate rollout opportunities for our positions. And we determine which potential one we might use based on our expectations going forward. What do I mean by that? If I'm in a covered call position, cash secured naked put, even a bull put credit spread, and the stock starts to move against me and hits my trigger point or starts becoming a loss, goes below the break even, before I roll, I'm going to look at the position as a whole again. We'll talk about that more in a moment, but I'm going to reevaluate the stock as if I was looking at it brand new. What do I think is possible with this stock position? What are my expectations going forward? Would I open this position today as a new bullish strategy? I want to walk through that, then evaluate the rollout opportunities, see if there's any way that I can turn this loss of 5.2% into a winner. And we do see some opportunities here, but they come with slight caveats as well. Of course, I could also manually evaluate adjustments, and we're going to walk through that also as well. And the second one, the boom position, we might not get what we want. In this case, on February 22nd, I believe I said, but we have it in the portfolio. We're going to take a look at that in just a moment. The stock was trading at 67.78. Might have taken a similar out of the money covered call, selling the 70 strike for today's expiration on February 22nd for 210. Takes the cost basis down to 65.68, essentially the break even. Stock's at 55.27. And we're at a loss right now of about 19.7%. Really at expiration today, when that call went to zero, we're at a loss of 15.8%. Almost 3 times more of the loss we're sitting on with the DAR example. But let's pause for a moment now. Let's navigate over to PowerOptions. Perfect, that's a little bit better. Let me clear up the drawings there for everyone. All right, so here we are looking at PowerOptions. Now I know I've got 2 potential covered call trades that didn't really meet my expectations, and we're sitting right now at a loss on this position. What I'm going to do now is I'm going to go to the portfolio. We're going to go to the portfolios where we track our open positions. Here we see the DAR position. As I mentioned, 78.52. Sold the 210 call. But the stock has dropped 8.5%. We're sitting at a loss at 6% on the position as of right now. The expiration value is a little bit less. It's exactly, it's the same, exactly 6%, excuse me. So I have a position that's underwater. The stock had moved against me for a covered call. Now I'm going to use the More Information button, go to Position Actions, and then Position Analysis. Anytime you're tracking a position in the portfolio, you go to the Position Analysis view, you see a breakdown of your current position. Compare the current liquidation value to future expiration value. Now, they're the same here in this case because we were selling a March expiration position. So today it expired March 19th. So we're at the full 6% loss, or a loss of $455. DAR did close today at 71.87. It was a little bit different when I was putting the slides together. So we continue to scroll down, and here are those rollout opportunities. Now, let's talk about where we are. We entered the position at 78.52. We sold a March 80 call for 210. So we have a cost basis of 76.42, or 76.42 per share, if you want to say it that way. The stock's at 71.87. We hedged some of this loss with the premium we receive, of course, essentially from the expired now March 80 call at 210. So what are the rollout opportunities showing me? Well, we're at a loss, as we saw, of 6%. I could roll to the April 70, or right before the close, I could have rolled to the April 70. And if the stock stays above 70 and I got assigned, I'd still have a loss of 2.6% for April expiration. Much less than 6%, but it didn't get me to a winner. Now, if I go to the April 75, we take in 210. I could take in another 235 by selling the April 75 call. And my new net credit, this net credit field, this one's showing my original premium received. The adjusted net credit here is the combination of that original premium from my first call to the second call if I chose to sell it. So this would be 443. It would lower my cost basis from 76.42, but not quite to a profitable position yet. Why am I showing a profit of 1.2%? Because that is if the stock is trading at 75. Remember, right now we still have a cost basis of 76.42 with our position expiring worthless. Taking in this remaining 235, it's going to put us down to 74.07. Not to break even yet. I'm still below the cost basis. The stock is still below my cost basis, even with selling this call. Why is there a positive return? Because now with my new cost basis of 74.07, we sold that call for 235. If the stock is trading at 75, we'll make 93 cents or 1.2%. This is where that reanalysis comes into play. Whatever caused DAR to pull back in the last 10 days, since it was trading up at that price of 78.52 when we got into it before we sold the call, do I feel that trend is going to continue down in price? Do I feel the stock's going to continue to move? Or do I feel that that was an overreaction to some event, market weakness that pulled the stock down, and I feel I'm still in a good, strong, stable stock, and it may still go up to 75? If this does not meet my expectation, I may have to go out to May to the lower 70 strike call for only a potential return of 0.5%, but at least giving myself still a 55% chance of getting assigned and turning a 6% loss into a 0.5% gain. This is where that reassessment comes into play. I can't roll for a profit to April if I feel the stock's going to continue down. I want to be in the money for more protection, Oleg. I can't do this. I could do this. It would be less of a loss, you're right, but why lock myself into a loss with a declining stock? I may have to go further out in time, and I'm playing defense now, but for only a 0.5% return. This is where we also have to stop and have another brief conversation. You are in covered calls or any strategy for a specific reason. You have a trading plan in mind. You have a target goal. This is a very high potential return we saw, but let's say my goals are every 30 days, I want to try to make at least 2 or 3% return on the investment. Well, I'm already down 6%. So for the next 30 days, next 40 days, if I turn that 6% loss, or 63 days, I turn that 6% loss into a 0.5% gain. Technically, I am hitting my goals of 3% every 30 days because I have to make up this 6% loss. But if I no longer feel strong about this position, I no longer feel safe that this is going to continue to be a bullish stock, which is what I'd want to get back to this 0.5% return right now, or less of a loss, or maybe 1% if I'm bullish again, that would be a pretty good deal. Still keeping a positive net credit on the position. But that's the reassessment. That's what I really have to decide first before moving forward with just rolling for the sake of rolling. If this no longer matches your sentiment, Oleg, for the strategy that you're in, covered call, cash secured naked put that you're rolling down because it went against you, maybe it's best to cut out, take the 6% loss, and then make it back with 2 or 3 trades that are going in the direction that you want for the particular strategy. There is a danger in rolling for the sake of rolling. And remember, as the stock is falling, you're always technically losing more on the stock than you're gaining on the call or the new call that you sold. Stock has a delta of 1. In this example here, the stock dropped about $7. We hedged that with a $2.10 premium. But we can't make more than that $2.10 to hedge the position. When we roll down, we're going to collect another premium, but we're not quite back to break even. Here, with a new premium adjusted net credit of 663, we're not back to the loss we've taken at 78.52. It's about, well, it's close to it, but it's still a negative percent if assigned because of the lower cost basis in that case. So what are my targets? I'm in the covered call. Stock went against me. I go to the portfolio. I go to position actions and position analysis. I evaluate how to turn the losing trade into a winner, but with the caveat of what is my expectation going forward. Do I think the stock's going to rebound, or this April 75 call, getting another 235 and a potential 1.2 is still a good play because the stock I feel is going to recover, and I feel I have a chance for the stock to be at or above 75. If I think it's going to continue down, you'd want to play safe and maybe go with the 70. But again, even if you're assigned, got to go 60, maybe 90 days out or more to get a positive return. So that's my decision process for evaluating which repair I might use in a given structure if the stock had moved against me for a covered call. We're not always going to see a repair, are we? No, we're not. Let's take a look back. Let's get off of DAR for a moment. Let's go back to the portfolio. Let's take a look at Boom. February 22nd, stock was trading at 67.78. Similar position, sold an at or out of the money 70 call for 210. But the stock has dropped essentially 19%, and we are at, I'm sorry, I gave us a bad midpoint there. We're at about a 16.3% loss right now at expiration, down 1068 with this decline of $12.78 because we keep the 210. We're in a jam. We're in a problem. Follow the same path. Let's see if there's anything available. Go to position actions and then position analysis. We know, again, we keep the 210. We know we're at a 16.3% loss right now with our covered call expiring worthless. We scroll down, rolling anywhere out to April now, still a 10% loss. What's happening here? What's happening here is that we've lost much more on the stock, $11 on the stock, than the 210 we kept from the short call position. We're not going to get $9. We almost do here with the 50 call, but it's still a negative return because the cost basis is still way too high. We can't afford to get assigned at 50, even though we're kind of making back that premium right now. We take in 210, we get another 850, we're at 1060, but the stock's down about 11. Still not there yet. So what do we have to do? We have to look further out in time. Is there any way to see a winner? Again, reassessment 91 days out. might make a 0.5% return in this case if the stock's above 65. What are my expectations? What is my sentiment on BOOM, Oleg, now that it's continued to drop? Is this a smart repair, or is it again rolling for the sake of rolling? Whatever your stock is, in this case, boom, I'd have to analyze, well, I can get to a 6.3% profit, which probably wouldn't match my target goals for my trading plan over 91 days in this case. But again, it's better than what? A 16.3% loss right now in the position if we decided to get out of the stock, take the loss, and move on. But do I have any sentiment based on what the stock has been doing, how long it's been moving against you? Do I have any expectation that even in 90 days, this stock will recover and move from 55 up to 70? You might not. So is there anything else that you can do in these situations when you evaluate a rollout opportunity, it's still not there? Well, yes, you could manually evaluate a rollout opportunity going to the profit and loss chart or what if calculations. And I could evaluate rolling further out in time. We'd have to go to September, 182 days away. So remember, this expired worthless. So my cost basis is 65.68. So let me just change that on the profit and loss field real quick. It was 65.68 after my call expired. We didn't buy it back in this case. Let's go to September. And maybe the 55 call for September is going to give me a high enough premium here. No, sorry about that. So with only 940, because I'm 1068 below the strike, the deep in the money 55 with the stock trading right at 55 for September doesn't get me back to break even. I need to make up 1068, and it's not there. Be assigned for a loss. What about, I could go further out in time. What about the 60? Would this get me back to break even? No. But if I'm assigned at 60, if I get $7 or so, and the extra $5, that would put me $12 up. Would that give me what I need to cover the loss? Yeah, small profit again of 2.7%. Not really an expectation, and this is for 186 days. Is there anything else we can do? Well, there's one other thing that we can do possibly. If I don't see any good rollout opportunities because the excessive decline in the stock in the rollout opportunities in the position analysis field, I do my own what-if calculation, decide, no, I don't want to go out 180 days to September to repair this position. Maybe a stock repair will work. What is a stock repair? Well, it's a neat tool that we have here. And I know, of course, we're going to have a cost basis of 65.68 after my 210 call expires worthless. So I'm going to go here, or I can go under Signature Tools and go to Stock Repair. And we're going to put in 65.68 as our cost and 100 shares of stock. I'm not expecting to see anything here, but we might see something. Always good to check. Drat. Okay, so what happened here? We are trying to build a repair that's a ratio call spread that can help you get back to break even faster. You're going to buy a slightly in the money call, sell two out of the money calls in that case. And what that'll do is essentially create a bull call debit spread with a covered call that may help you get back to break even faster. On a whim here, an alternative, of course, I don't like doing this. No one likes to throw good money after bad. If you don't see a stock repair and you have the capital and you're set on trying to repair this particular position, you could average down. So we buy another 100 shares at, say, 55, which would put our cost basis at about 60.32 or 60.34. Okay. Now I have 200 shares at 60.34 after the call expires and the stock trading at 55. Still no repairs available. That's a shame. Let's use DAR. It probably has better premium to use this with. So this one didn't form a repair, but that's a potential that you might be able to do. So evaluate the rollouts. You don't see ones that are far enough out in time that gets you to where you need to go, then you could look at the stock repair. If it's still not there, 76.54, I think it was our cost basis after the 210 expired worthless. Okay. So here we did see rolling down the covered call to May, remember, for DAR. I know I went back to a trade, but we saw a May series 63 days out for DAR where we could get back to potentially a profit of, I think, 1.2% or 0.5%, excuse me, if we sold the 70 call. Well, if my expectations of the stock is going to recover slightly, hopefully by May, this repair here, even though my cost basis is still 76.54, I could do a ratio spread and get only 90 cents of net credit now, but the break even goes to 72.82. How is that possible? Let's take a look. I'm going to analyze the trade instead of repair details. So we've been on this topic for a while. This is just going to take us to the profit and loss chart. We own stock at 76.54. Buy a May 70 call at 7:30. Sell 2 May 75 calls at 4:10, so we get 8:20. There is our 90-cent net credit that lowers our cost basis on the position. Okay, that's the 90. So we're at 75.64. How do I make a break even now if the stock's at 72.82 if I only took in 90 cents? Because you bought a 70 call that was essentially received at no cost. Took in 8.20 and paid 7.30. Lower the cost basis 75.64. May expiration. Stock is at 72.82. The short calls expire worthless. You kept the 90 cents, and your long call is worth 2.82 of intrinsic value. So this puts you at 75.64. Sell to close the stock at 72.82. Sell to close the 70 call, 2.82 intrinsic, 75.64. You're at break even with just a little bit movement back up on $1, and you have the potential to make 5.8% if the stock is above 75. Because you get called out at 75, which is only 64 cents below your cost basis, and you get the bull call debit spread benefit of the long 70 call and the short 75. Essentially buy stock at 70. If it's in the money at expiration, sell it at 75, get another 5 points back. So you make a 436 profit, 5.8% return, and guess what? The stock's still below your cost basis of 76.54. When it works, the stock repair is very powerful. When you can find opportunities, the stock repair tool is very powerful. What does it come with? It comes with that same reassessment that you're expecting the stock to at least move back up a couple points to the break even in the next 30 to 60 to 90 days, and potentially could move up a little bit more, so we could still see a good profit from a 6 or 7% loss, but not at that. But that is a capped gain. But again, you have to have the expectation that it's going to move back up in price. And of course, as the stock was dropping for that doom example, you probably would have been rolling down consistently, Oleg. What we recommend, of course, is in that example where I had bought the stock and bought the stock at 67, sold the 70 call. When it dropped down to the $65 or $64 range, I might have rolled down at that time to the 65 for credit, maybe to April. And then as it continued to fall, rolled down to the 60, maybe for April. And then by now, I'm probably at the 55 or the 60 for May. I'd have rolled down continuously. But again, you have to make a decision of when you want to stop the losses. At times, it's best just to cut, run, maybe take the loss and make it back. Because as we saw with that other example, not the DA, well, we did see it with the DAR as well. But the problem with falling a position all the way down, you're continuing to roll down as it's continuing to fall, you're always losing more on the stock than you're usually gaining in the option premium unless you're going 90, 180, 200 days down. That's just because the way the deltas work. And you have a limited hedge when you sell the call, as you know, of course, Oleg, that you can't make more than that premium you received. And in this example on Boom, had I rolled down, when the stock started to fluctuate, and I rolled from my 70 call down to the, rolled down from the 70 to the 65. If it happened in the first week or two, I'm still paying time value on that 70. It's not zero. So I'm not making all of that 210 back right away. I might pay $1 to buy it back because it still has some time premium, even though the stock's falling. So I make 110 and then get another $2. Meanwhile, my stock's down 6 points and I've gotten 3. Way to counter that is go further out in time, but now you might be locking yourself into a loss, or locking yourself into 6 months, 5 months on a covered call to repair it. Maybe it's better to take the 7 or 8% loss on the covered call that's going against you before it becomes a 10, 12, 15%, and make it back with other positions later on. Now, for more information over the weekend, Oleg, if you have the time, remember you can always go to our webinars page, powerop.com/webinars.asp. The public page, under the options concepts, a few of these, the most recent one are only subscriber access. There's a look at a stock repair. It's a recent one, only 13 minutes long. But going further down this list from a few years ago in this section, there's one called Manage Your Broken Position. And it's alternative methods for managing a stock position that's fallen in price, covered call position that has moved against you, managing a sold put that is in the money and the stock has been put to you, conversations on managing bullish spreads. So it's a little bit of a lot in there, but it'll go more in depth into the ins and outs of the stock repair, other ideas, how you might consider managing that covered call position or other positions. But first step always, track the positions in the portfolio. As the stock hits your trigger point of when you would consider manage, use the more information button, go to position actions, go to position analysis, see what rollout opportunities are there, and what it might help you with to take that losing trade to a winner. Always key to remember, reevaluate the stock, reevaluate your sentiment to make sure it's worth it for you to manage that position going forward.